All right, good morning, everybody. Getting a little bit of a bump this morning. Leads us to the question of, is it a dead cat bounce? Or are we really trying to finish the last 2 days of the Santa rally? I'd say Santa didn't come and is not going to, but we'll look at the lines and levels and define what sort of breakout we have to get if this is going to be more than just uh, a bounce on support with a rally into resistance before we roll over and make a new leg lower. So we got the NASDAQ up the most at 1.25 and Japan down the most at almost 1%. That's the spectrum that we have to deal with. Looking at things that deride through the middle, Hong Kong down 1/4 with the Dow small caps and the S&P close to 1% on the upside. So, it's like a wave or a cycle. You start in Australia, then Asia, Europe, US. And we can see it didn't turn out well for the Asian session. Europe is still open, trying to come up, and then the US doing its own thing. Keep in mind, when Europe closes, we can feel that. So it's a time you're going to want to pay attention to today, see if things begin to change. We're going to get that jobs data that we were looking for, and ISM manufacturing this morning too. A little bit of Fed speakers chipping their teeth, and the afternoon should be fairly quiet. I don't think we have much in the afternoon to deal with. We are going to get some data out of Japan in the overnight, but it's not going to bother us during the intraday today. I did hear some of the drone names we were looking at last week. A couple of those names were getting downgraded, and then of course there's big names connected to drones too, like Raytheon, Boeing. Those sort of names are getting whacked to Stellantis, but for an entirely different reason. Still, they are in the drone space. The China 2-year yields are down at a crazy level, close to 1% and dropping underneath it. It's kind of freaking out a couple of macro to micro analysts. And to be fair, even they're like, what the heck is going on? Man, if the pros don't know, what the rest of us are going to do, right? So I'm pointing it out. It's freaking out the analysts. They don't know what to do with it. I certainly don't know what to do with it. My take on it is it connects to the stimulus that China's been putting out and the promises of stimulus that China's been putting out. So, while we look at the 2-year for Japan or China or Europe, Germany, when we try to make correlations, take it back to like the 07, 08 financial crisis. It was around these levels for China too back then. They've been putting out a lot of stimulus, a lot of promises, and it could be that, right? It could just be connected to that. I'm pointing it out. Be mindful of it. Maybe find a couple articles that dig a little deeper into it. Just keep your eye on China, right? And this isn't a surprise. We were talking about China being a good play into 2025. because they're going to have this big political event that they do every year. And the idea is that all this promised stimulus will actually turn into real stimulus, and that those KWEB constituents or those China ADRs are finally going to catch a bid. So Baba, Baidu, JD, PDD, Neo, XPEV, all of those names, right? And then of course Copper and other plays that you would connect to China. On the other hand, it is freaking a lot of people out because it can connect to global instability, contagion, kind of take that down the rabbit hole. So here I got the 10, the dollar, and the ES, the futures. You see the dollar kind of breaking out, making moves to the upside today above 108.5, and it's pulled back a little bit now, but it's still above 108.5, and that's a big deal. Needs to go in the other direction, right? We need that thing below 108, and it's moving to the upside on a breakout. But the 10-year is pointing down towards 4.52. We need it below 4.48. So at least it's within the range. It's not breaking out of the top of it, but it's not at the low end of this range yet either. And it's got some support or some structure there. Get the ES here. It was underneath the 10-week, fighting it for a couple hours. Then we had that solid push. Some flows came in, brought it up through the 10, through the ADR half, and they took a front run on that 6,000. 59.92 cog line, barely made it above that. Now we got this little intraday evening star reversal. We got a concept about these ADRs that if we get there early enough in the day, we can go to the other side by the end of the day. That would be going all the way to the other ADR, 59.13. Now, we're not looking at that because we're broadly bearish in the market. We're looking at that because statistically, that's what we do. If we hit one side early, a lot of times we go to the other side by the end of the day. And that doesn't come from me being bearish, just comes from, how many times we've done it in the past. We are inside day breakout, and that ADR lined up really well with yesterday's high. It's not perfect, but it's close enough that I don't even need to draw the line. So if we stay above the ADR half, then we're staying above yesterday's highest point. That's the ADR half inside day breakout combo, basically. If we keep that breakout, then we can just keep right on going. We've got 6,000 as a round number to deal with, 6011, the 10-day moving average, the full ADR, and then a 20-day moving average close to, well, on the other side of 6032 cog line. There's no reason to suspect that we can't do that. And we can get all the way up to 6032, and that would give us an inside day breakout on the week, right? Be an inside a week breakout. Is check the week's high. If you want to count that little wick up that we got Sunday, then we made it to 6036. But I think 6032 is just the better line to focus on. We get above 6032, then we have a breakout on the week and we could really grow some legs and run this thing. Otherwise, if we get back down below this ADR half, then we're back inside of yesterday's range and it's game on to the downside. It doesn't owe us a move to the downside, by the way. We could come back in this red line and we could just chop here all day doing nothing. All right. So it doesn't owe us a breakdown. It could look very similar to what we had in the later part of this day here. This is the previous day's trading where we just did nothing, right? We did a whole lot of nothing for hours. So we have a breakout started. If it fails, we can come back in. Just keep in mind It doesn't have to get crazy out there. There's no market maker move this morning. They're not hedging. They're not worried about hedging. Volume's looking good, especially for this, for a short week. Looking at 86 on a short week, it's pretty impressive, right? So we got plenty of volume. This is a weekly that we're looking at. So the blue line is the 10-week. The green line is the 20-week. You can see we're well above the 20. We're interacting with the 10 right now. But when we take all of that stuff off and we think about whether or not this is a dead cat bounce and what are we going to get out of it, we need to keep higher than this low here. Now, some analysts won't use the wick. They'll use the last bodily structure and they'll say, well, we've already gone too low. We should have held above that low. I want to use the wick 58.66. That's the low that needs to hold. We don't want to even get there, let alone get below it. So on the idea of, is this a dead cat bounce? Are we just going to rally into resistance before we leg over and go lower? We can't tell at this point. We still have to make the next leg. So if it comes up and it fails to get this high, and it fails to get higher than this high, it's very likely going to roll down, check its own low, break that, and put in a new low. Thing is, we just don't know yet, right? We can't anticipate which direction price is going to go. If it's just going to rally up into the half point, $6,009. So we can run up into this, reject, roll over for the next leg down. Or if we're going to get back up, challenge the high, try to get a breakout on the high, we need a higher high and or a lower low. If we don't get that, then we're just maintaining this complex topping pattern, and it still hasn't resolved itself yet. When you put it on a weekly, it's just a pullback. It's not even a topping pattern. It's just a pullback. And of course, for the month, we're still above last month's low. Today's central pivot was lower than yesterday's. That's bearish. Price opened up within it, which is also bearish, and then broke below it. Now we got back above it, and in theory, we're bullish above, bearish below. It's a narrow channel. At least it's more narrow than the previous day's channel. And a narrow channel implies that if we break out, we could get legs and really run. We tested S1, we tested R1, and we managed to break through R1. So now on this pullback, it needs to hold above R1. Otherwise, it's more likely that we come back and we test the floor pivot again. R1 is 59.75, so kind of a line in the sand. It needs to keep that. If it can keep it, then we can challenge the round number and 60.11, which is R2. The floor pivot on the week is 60.32. It's another level that we were talking about. So not only is it the week's high and a cog line? It's also the floor pivot for the week. Love how all these things just stack on top of each other. Thought we had a point of control back here too at 60.32. Either way, on this current push this week, the week that we've got, the point of control is below us, so it's not in our way. We have last week's point of control at 60.20, so that'll be another level to the upside we have to work through. And as a structure, it's not too wide, 30 points or so from 6,000 on the low end to maybe 60.32 or 60.40 on the upper end to be all of this volume here around that point of control. Well, it's not looking good. We're failing that ADR. So this is a bit of a liquidity gap. Be mindful that we could come back down to where this run started just to close the gap, so to speak, and then resume our bullish move out of that breakout. But let's just see how it plays off. Otherwise, this is like a micro blow off top, right? I didn't see that, but I'll go hunting for it. I appreciate the heads up on that one. That's a good one. I'm going to dig deeper into that. Let me grab a screenshot of that. So a 10-day, 30-minute volume profile. We got the point of control moved down like we were talking about earlier this week, that it was going to drop off of those highs. The idea or the hope was that we would already be above that level before it got here so that it wouldn't be something that we have to fight. Unfortunately, we didn't get above it. Now we've got this resistance directly overhead, and I am going to consider it a resistance. You know, a lot of times with these points of control, we don't really look at them as a function of support or resistance. They're just areas of interest where we expect price to have a reaction in the market. But at this point, I'm going to look at it as a direct correlation to resistance. I would expect that to be a trouble spot. Just like they took a front run on 6,000 and rejected price before it even got there, I would expect the same behavior at 60.11 with this point of control too. Yeah, the swiftness of a lot of these announcements, you know, where they're not going through the proper or the not proper, the usual channels, and the we heard the same thing. Uh, I don't know. It's the contagion that's coming out of Germany, right? I don't know if you've been keeping up with that, but there's been a lot of grumblings about the contagion and trying to isolate Germany and how it's not working out so good for those guys. But this, like you said, is going to hit home, right? What happens in Germany, it doesn't really hit home, at least not in my home. All right, so that point of control that we had marked out earlier in the week, it served us well Tuesday on that half day. We're done with it at this point. You can see we ran right through it like it wasn't even there. And it wasn't a VPOC anyways. We'd already hit it, taken it out. If there was any doubt left at all, it's been resolved at this point. So we're done with that line. We look at Tuesday's levels. We don't have a VPOC to carry forward. So we have no new lines to add. And looking at the distribution this morning, everything's fine. Nothing really stands out as concerning. We're still within the range of the week. Not a surprise. It's what we're expected to maintain for the week, that will stay above 59.50 and yet we'll stay under 61.11. Just remember, this week doesn't owe us anything, right? We've been hearing in the news it was a good year. It's been a good 2 years, great run. Everybody's still excited for more. There's, renewed optimism, blah, blah, blah. All of that bullish bias and animal spirit still there. And sure, analysts still need to reevaluate, the earnings that we've pulled forward for the last 2 years. But so far, everything is still holding up. So finishing out this week in this sort of hold the line sideways market behavior kind of fits. It makes sense. There's no reason for a radical sell-off, but no fuel for a significant rally either. Looking at the 10-week, we're holding the line. We're just there. It's kind of where you want to be. If you're starting out, start out on solid footing. Looking at the 10-day, we are below it. As ugly as this appears, it is a wave. It's just kind of a choppy wave. But we dip below the 10, then we get back above, and we sustain that run usually for a couple of weeks, right? It's just waves where we're up and down, up and down, up and down. And if we were to turn that sideways at a bit of an angle, it would match with price, right? Where we're just running the same way. So we're kind of under the mean. If you look at the 10-day as the mean, we got to get back above it. But it's just a wave. So until this thing starts to show us waves to the downside, then we have to treat it as what it has been. It's just waves. When you pull back at this distance and kind of look around, this is what waves to the downside look like. And that's waves to the upside. So until it changes, we don't have a big bearish market to be scared of, and we just don't have it yet. Wow. Come on, Thinkorswim. You can do it. Maybe. All right. Maybe not. Quitter. So we got the China constituents down, whether you're looking at the yen ETF or the MCHI, or I like KWEB. All three of those are down. VIX is down. Looking at what's up. Bitcoin, the Mag 7, Nat Gas, which is, I mean, that's just a joke, but whatever. It's up. Uh, Gold miners, precious metals, uranium, semiconductors, chips, bonds, tech. You know, when people ask me, what do we need for a rally day? If we're going to get bullish, what are the sort of things that I need to be looking at? What sectors do I want to see? This is exactly what you want to see. The chips are up. The Mag 7 is up. Technology, consumer discretionary, everything but financials. Well, you know what? Even financials are up down here. Those three sectors are the risk on sectors that you have to have for that rising tide scenario. And we have it. Not only do we have those three, but then we can compound that and say we also have chips, communications, and the Mag 7 group all by itself could do it. You know, but we have that as well. So we have everything we need for a rally at this point. And we're not talking about just, you know, a rally outside of yesterday's levels. We already did that. We're talking about a rally on the week where we could get to the upper edge of the week's expected range in a single day. One of those kind of rallies. A good 1.5%, 2% kind of moves, right? This is exactly what you got to have. So at this point, while we never know for sure, right? This doesn't guarantee that we're going to get a rally. This is the exact thing that you would want to see if you're looking for a rally. So once the market opens, Thinkorswim has this visualize tab. Get rid of the heat map, swap it out for the index. And you can detach these so you can stack them up. They make a very small footprint when you're done. So, you know, go in, set one to the S&P 100. It gives you the advancing minus the declining issues and money flow. All right, so it's not just the AD, but it's also the volume and the money. So you can see if the money matches what is up or what is down. And that's just the S&P 100 here. So you can tighten it up, make it a very small footprint. And then you can do another one, say for the NASDAQ. And you can do another one for just the Mag 7 or for your own watch list, right? You can make your own list. So what you want to see this morning, if we're going to get one of those days, you're going to want 95 or 92 names out of 100 all doing the same thing. That's what my alpha protocols are built on, right? The idea that retail traders can trade like an algo. You know, if we get bullish enough on a given day, that you just buy calls in everything in the alpha list. Or, you know, if we get crazy negative, then you just buy puts on everything in the alpha protocol list. But the trigger for that, for me, is 97 names or above. You don't have to wait until we get that extreme of a correlation, but that's my benchmark. Either way, this morning, if we're going to get one of those kind of rally days where we just keep going and going and going, you're going to want to keep your eye on the total market breadth, because you want this thing to be a rising tide that lifts all boats, everything running together. It doesn't have to be that way, but it'll be a stronger run if it is that way. And you can stack these up, have as many as you want. Unfortunately, though, every day you got to go in and redo it, because every morning it will reset to the heat map, and you got to go back in, choose your index. But so what, right? It takes 30 seconds and you've got it rebuilt. So it's looking good. We've got a broad representation in the market. We want this to stick. Keep your eye on risk, like Bitcoin. It's going to be one of the best tells on risk, but don't lose semiconductors. Precious metals, at this point in the day, they're not going to dump us in the sand if they stop participating. Or just keep my eye on total market breadth. But so far, it's looking good. So it lines in the sand here. Let's just kind of clean this up a little bit. Now, it's a strange thing about these ADR lines. Right now, we're looking at the ES because the SPX isn't open. So at 9:30, when the SPX does open, it will get its own ADR lines. And what I've found on these days where we really go and we just run and run and run, and we're trying to figure out, when is the ES going to stop running? And it goes past the yellow line and it just keeps going. And there's no line left and it just keeps going. And we're trying to figure out, where the heck is this thing going to stop, man? It just keeps going. Go to the SPX at that point and check to see, has it hit the red line yet, let alone the yellow line. They don't match, right? Because the SPX is going to get ADR lines from where it opens up. So at 9:30, it's going to have ADRs above and below. Just like it did here, it opened and there was ADRs on each side. And if you think about what we did, in the previous session, the ES had already moved to the yellow line, to the ADR line, I mean. So the same thing today. If we keep running to the upside and at 9:30 we open, look at the SPX. If you're trading the ES and you're trying to answer that question, how much farther is this thing going to go? We'll probably keep going to the upside at least until the SPX gets to the ADR line. And it doesn't have to stay this way with China. China can stay down. We don't need them to rally. But if we're looking for an everything rally, then we would want to see China, solar, crude, that sort of stuff come around. It doesn't have to, though, right? We're just looking for it to stay in that broadening formation. Simple enough. Be a pretty easy day to finish off this pretty easy week. So I got for you guys. Be careful, be safe. I'll see you all tomorrow.